Hey everyone, welcome back to the channel. Today we're diving into the stock market's worst day in over a month. Yeah, that's right. Big tech took a nosedive and Wall Street didn't handle it too well. So grab your own emergency stock watch juice because this ride gets bumpy. We'll unpack why Microsoft and Meta are in the doghouse, why your retirement fund might be feeling the burn, and what this all means for you, even if you don't have a single stock in your portfolio. So let's start with the cold, hard numbers. Today, the S&P 500 tumbled 1.86%, landing at 5,705.45. The Nasdaq, our tech-heavy friend, didn't just slip. It face planted, losing 2.76% to close at 18,095.15. And the Dow Jones, it dropped 378 points, or about 0.9%. So basically, everything's red. And not the good kind of red like holiday decorations. It's like Wall Street collectively spilled coffee on their keyboards after seeing those tech earnings. Investors were not impressed. But why did this happen? Well, Microsoft and Meta kind of missed the mark on their earnings reports, and that sent everyone into a bit of a tailspin. Let's talk about Microsoft first. They actually beat earnings expectations, which sounds great, right? But then they said something along the lines of, oh, by the way, next quarter might not be so hot, and bam, their stock dropped 6%. It's like nailing an interview, but mentioning at the end that you might be late every day. Not exactly a confidence boost for investors. And then there's Meta. Facebook's parent company dropped over 4% because their user growth didn't meet expectations, and they announced that they'll be spending a lot on capital expenditures next year. Imagine trying to impress your boss, but accidentally revealing your plan to blow the budget on fancy office snacks. Yeah. Investors weren't thrilled. It's almost like these companies thought AI was a magic word that would keep stock prices up forever. But as one analyst put it, AI enthusiasm just isn't cutting it anymore. So big tech's facing a reality check, and that's dragging the whole market down with it. Now, you might be thinking, I don't own stock in Microsoft or Meta, so why should I care? Here's why. When big tech sneezes, the entire economy catches a cold. Stocks like Microsoft, Meta, and Amazon make up a huge portion of the market. When they go down, so does your 401k or that little retirement fund you've been building up. And if that's not enough, remember, these tech giants shape a lot of what we use every day. If they're tightening their belts, it could mean job cuts, slower product rollouts, and fewer updates. So yeah, even if you're just out here trying to scroll TikTok in peace, big tech struggles will impact you. And just when you thought it couldn't get any worse, we've got inflation to talk about. Today's data showed the Personal Consumption Expenditures Price Index, or PCE, up 2.1% over the past year. This is the Federal Reserve's favorite inflation gauge. So basically, the Fed's like, we're so close to that 2% target, we can almost taste it. But here's the twist. This inflation number, combined with tomorrow's jobs report, will guide whether the Fed raises interest rates next week. And you know what higher interest rates mean? Yep, those lovely credit card rates get even higher, mortgage rates climb, and that loan you've been considering, probably a bit more expensive. So, the Federal Reserve's meeting next week could be a game changer. Analysts are betting on an interest rate increase, but it could go either way depending on tomorrow's jobs data. If they raise rates, it's basically their way of saying, hey, spend less and save more. But for many people, that's easier said than done. Interest rate changes affect everything from mortgages to car loans to that buy now, pay later habit we all picked up in the last few years. So yes, this decision will impact your wallet directly, even if you've never touched a stock in your life. And if tech stocks and inflation weren't enough, oil prices decided to jump nearly 1% today thanks to OPEC hinting that they might hold off on a production boost. Basically, the world's biggest oil producers are teasing us like maybe we'll increase supply or maybe we won't. thanks, OPEC. Oil prices affect gas prices, which affect everything else, groceries, shipping, you name it. So even if you're not watching the oil market, trust me, it's watching you. So what should you do with all this information? First, don't panic. Market ups and downs are normal, even if today felt more like a roller coaster. Here's a simple checklist. 1, stay calm. Seriously, don't go selling off everything because of one bad day. 2, consider diversifying your investments if you're mostly in tech. A little variety never hurt anyone. 3, keep an eye on interest rates. If you've got big loans, it might be worth considering refinancing or locking in rates before they rise. And finally, brace yourself. This isn't the last market shakeup we'll see, especially with the US presidential election just around the corner. All right, that's our breakdown of the market's worst day in a month and what it means for you. If you enjoyed this roller coaster, make sure to hit that like button, subscribe, and ring the bell so you don't miss our next market update. And hey, drop a comment below. Are you feeling the squeeze or are you just here for the drama? Let's talk about it. And remember, no matter what happens in the stock market, you've got this. Even if it feels like the universe is trying to mess with your wallet. Until next time, stay smart, stay savvy, and keep an eye on that portfolio.